Hello, I'm Mike Stecher, co-founder of Stecher Financial Group. It is my pleasure to introduce you to my associate, Mike Nichols. In this video, we will be sharing information about college funding. The college funding expense will be one of the largest expenses you incur throughout your lifetime. None of us want to place limits on our children's dreams.
And that means having a lot of assets saved up to create that opportunity. And another thing to consider is that it's hard to envision preparing for something so uncertain. For instance, what if my child's dream is not to go to college, but to start a business, or they become an artist or an athlete? I mean, that takes money too.
We're going to show you several financial tools you can use to save for your child's future.
As always, one of our goals at Stecher Financial Group is to listen to our clients' current situation, their plans, and their hopes for their children. Then to help you sort through all the options and pick the best strategy. It's important to note that the ideas we present here are not for everyone. And without sitting down together and finding a plan that matches your individual needs, you certainly shouldn't begin without consultation first.
You know, Mike, that's very true. The window of time you have to save for your children's future is rather short. The elements of the plan depend on when you start to save and how old your child is. We would be glad to meet with you to get a plan together. Mike, why don't you take them through the process?
Sure thing, Mike. Thank you. If you've already begun to investigate savings tools for your child, then you've probably already become somewhat familiar with 529 plans. This is an account that is particularly designed for college and higher education savings only. A 529 plan is funded using after-tax dollars and has a tax benefit on gains. The gains would not be taxed. However, these plans only function this way if the money is used for college. They are set up per child, and a once per year beneficiary change is typically allowed. Now, the investments in 529 plans are usually target date allocation funds, with the target date being the year the child would be likely to start college. Some very important things to keep in mind. If money inside a 529 plan needs to be taken out for another purpose, or your child does not decide to go to college and you need to use the money for other things, there's a hefty 20% tax penalty on the money. Another point to note about 529 plans is that the investments that can be used are generally quite limited. This makes them difficult to manage and doesn't give many options for reallocating those investments should there be any changes in the market. Another financial tool that has a bit more flexibility is something called a UGMA or UTMA account. These are accounts that gift or transfer ownership of the account to the child when they reach adulthood, which is typically the age they are college bound. Now, these accounts don't have the tax benefits, but they do have a vast range of investment options, similar to the investment flexibility you can find in an IRA. Another benefit is that the funds in these accounts are not tied to the required use of college education, but are literally funds that transfer to your child at 18. They can be used to help their life move forward in any way they choose. Keep in mind, though, they would have complete control over the funds from 18 on. So if you're worried about them choosing to buy a shiny new sports car instead of using it towards their future, well, then this might not be the option for you. The next tool is the use of a non-qualified account. Non-qualified accounts typically require a larger sum of money to start up, so they're great if you have some money already saved but sitting in a bank or money market account. Non-qualified refers to the tax status of the money. It's an after-tax investment where the gains would be taxable upon withdrawal. Now, although these accounts offer no tax benefit in regards to college savings, they do allow you to save using a wide diversity of investment options. Now, since it's not designated to a beneficiary, it can be used for any of the children. It can be used for college or as startup money for them. Or even in the case that they end up with a full scholarship, the money could then just be additional savings and retirement money. Non-qualified accounts also don't have any age requirements or penalties for drawing on the money. Lastly, I'll describe one of the methods I find to be the best. It may surprise you, but this investment tool has flexibility, tax benefits, diverse investment choices, no age requirements for distributions, no penalties for distributions, and it also offers a death benefit. It's life insurance. Yes, I did say life insurance. Now, most folks know life insurance only as a protection tool that is used for coverage in case they happen to predecease. But life insurance has a number of different ways to be set up, and when done effectively, it can actually become one of the most effective financial tools because of its multitude of benefits. The types of policies I'm describing are permanent policies, not term, which folks are more widely familiar with. More specifically, I'm talking about variable universal life policies. Policies like this are first and foremost life insurance policies, but they are designed to last permanently with the appropriate funding. These policies create a cash value, and this cash value in a variable policy can be established within a diverse portfolio of funds and gain the growth of the market. If done correctly, and before the cost of insurance becomes higher, these policies can be very affordable to fund at levels where the cash value can quickly exceed the cost of insurance. The result is a life insurance policy and after-tax investment that can be built at the same time. Now, the cash value in the policy can be used for anything, as in the non-qualified investment or UGMA, but the distributions from this investment can enjoy tax-free gains as long as the policy remains in force. This is similar to the tax-free gains you'd see in a 529 plan. Furthermore, let's not forget it's a life insurance policy, which is a cost all of us with children should bear as it protects them in the event of our unfortunate passing. So in a sense, it's self-completing. This tool is very effective, but it's slightly more involved, and so it needs to be set up properly. If you're interested in using this method, you'll definitely want to schedule an appointment, and I encourage you also to view our next video where we'll be presenting life insurance as its own topic. I hope you found this segment informative, and if nothing else, it gave you some ideas to consider how to start. As Mike mentioned earlier, the window for saving for our children is rather short, so it's important to act quickly and get a plan of action in place, and to make sure that that plan fits in with the rest of our financial needs so that you can effectively budget and still cover all your goals. For more information, contact us to set up an appointment, and we'll be happy to come out and meet with you. I'm Mike Nichols with Stecher Financial Group. Visit our website and keep an eye out for our next video segment. Thank you.